How can a company be recording millions in profit and still go bankrupt? How is that even possible? The answer, as we are about to see, is all in the cash. And we are going to do this by building up your knowledge of the statement of cash flows piece by piece. In this lesson, we are going to break down one of the components of a complete set of financial statements, the statement of cash flows, all guided by International Accounting Standard 7. First, we will cover why cash flow is such a big deal. Then we will define all the key terms you need to know. After that, we will jump into the three main pillars of activity, compare the two different ways to report them, and then wrap up some of the trickier details. First things first. What's the whole point of this statement? Why do we even have it? It really boils down to just one thing: tracking the real, actual movement of cash. The income statement can be shaped by different accounting rules and estimates, but the cash flow statement tells you where the hard cash came from and where it went. No ambiguity here. It is the absolute lifeblood of any business. And when you use this statement alongside the others, it becomes an incredibly powerful tool. It lets you get a real handle of a company's financial structure. We are talking about things like liquidity. Can it pay its bills next month? And solvency, its ability to survive long term. It really shows you if a company can actually pay its debt, fund its day-to-day operations, and invest in its own future. Let's look at some definitions. You absolutely have to know these key terms. Think of them as the foundational building blocks for the entire statement. First is cash. This is pretty much exactly what it sounds like. We are talking about physical money, the cash on hand, and the money just sitting in the company's bank accounts, ready to be used at a moment's notice. Simple as that. Next is cash equivalents. Now think of these as things that are almost cash. They are super safe, short-term investments that can be turned back into a known amount of cash really, really quickly. Now we get to our first big category of activities: operating. These are the core day-to-day things that a company does to bring in its main revenue. It's the main reason the business exists. Next is investing activities. This is all about how a company is using its money to set itself up for the future. It involves buying and selling long-term assets, things like buildings, machinery, or even buying stakes in other companies. These are things that help the business make more money down the road. And finally, financing activities. This section tells you how the company gets its funding. It's all about tracking the money flowing between the company, its owners, and its lenders. So think about taking out a new loan, issuing more shares, or paying back debt. So we've got the definitions down. Now let's make this stuff real. We are going to look at some concrete examples of each of these three categories of activities, so you can see exactly how cash moving in and out of a business gets classified. First is cash flow from operating activities. This is the heart of the business and is probably the most important indicator of a company's health. It is an indicator of the extent to which the revenue-producing activities of the entities have generated sufficient cash flows to maintain operations without the need for external sources of finance. Operating activities generally result from the transactions and other events that enter into the determination of profit or loss. Examples of cash flows from operating activities are cash receipts from the sale of goods and rendering of services, cash receipts from royalties, fees, commissions, and other revenue, cash payments to suppliers for goods and services, cash payments to and on behalf of employees, and cash payments or refunds of income taxes. Next is the cash flow from investing activities. These cash flows represent the extent to which expenditure have been made for resources intended to generate future income and cash flows. This category is all about strategy. It shows you what a company is doing with its capital to grow over the long term. Examples of cash flows arising from investing activities are cash payments to acquire property, plant and equipment, intangibles, and other long-term assets, cash payments to acquire equity or debt instruments of other entities, cash advances and loans to other parties other than cash advances and loans made by a financial institution, cash receipts from sale of property, plant and equipment, intangibles, and other long-term assets, cash receipts from sale of equity or debt instruments of other entities, and cash receipts and payments of advances and loans to other parties other than cash advances and loans of a financial institution. Finally, we have the cash flows from financing activities. This shows how the company is being funded by its owners and its creditors. It is the financial back and forth showing how a business raises money to operate and grow, and also how it returns that money back to its investors. All of these activities directly change the company's capital structure. Examples of cash flows arising from financing activities are cash proceeds from issuing shares or other equity instruments, cash payments to redeem the entity's shares, cash proceeds from short-term or long-term borrowings, and cash repayments of amounts borrowed. Now, here is a really important detail you need to know for that operating activities section, and only for that section. IAS 7 actually gives companies a choice. They can present the information in one of two ways, the direct method or the indirect method. On the one hand, we have the direct method. This method just shows the major classes of gross cash receipts and gross cash payments. On the other hand, we have the indirect method. This one starts with the net profit from the income statement and then works backwards, making adjustments for all the non-cash items like depreciation. Now, here's the thing. IAS 7 actually encourages companies to use the direct method because it is clearer. But you are going to see the indirect method way more often in practice because it's just a lot easier to pull together from the existing accounting records. Let's wrap this up by covering a couple of the trickier parts and some important disclosure rules. Now, this is where it gets kind of interesting because there's actually a bit of judgment involved. Take interest paid. For example, a company can classify that as either an operating or a financing activity as long as they do it consistently year after year. And here's a crucial big one. Significant transactions that didn't involve any cash at all, like say buying a building, by giving the seller shares in your company. They are completely excluded from the statement itself, but you have to disclose them somewhere else in the financial reports. In the end, it all comes back to this core idea right from the standard itself. The whole purpose of the statement of cash flows is to give you, the analyst, the investor, the manager, a clear fact-based picture of a company's ability to generate cash. And that is the ultimate measure of its short-term health and its flexibility to jump on new opportunities. I will leave you with a final thought to chew on. There is a famous saying in accounting that you will hear a lot. Profit is an opinion, but cash is a fact. After everything we've just covered, Which one do you think really tells you more about the true state of a business? See you in our next lesson.